Hello guys, come on, let's quickly revise Accounting Standard 1 Disclosure of Accounting Policies. To start with, what exactly do we mean when we say accounting policies? Accounting policies are accounting principles and methods of applying these accounting principles in preparation of our financial statements. You cannot complete your financial statements without coming across accounting policies. In various segments of preparation of financial statements, you will surely come across accounting policies. To give some examples, whenever valuing inventory, which method of accounting policy should you apply? Which method of valuation of inventory should you apply? Should you pick first in, first out? Should you pick simple average method? Should you pick weighted average method? Accounting standard 2 tells that you can pick between FIFO or weighted average method for items which are ordinarily interchangeable, and specific identification method for items which are not ordinarily interchangeable. These two options what accounting standard 2 provides us, among which we can pick one, is an accounting policy. Similarly, in terms of valuation of fixed assets, there are two models which accounting standard 10 PP prescribes. We can either follow cost model or we can follow revaluation model. Whichever one you pick is your accounting policy. So in this way, whatever the policies which are given as an option by the standard for us to follow is our accounting policies. So accounting policies, as I just mentioned, it is significant accounting principles and methods of applying these accounting principles in preparation of financial statements. Similarly, in investment accounting, you have an again option to do FIFO or weighted average method. When you are trying to value retirement benefits, again you have option. All of these options together is what we call as accounting policies. Now, how to pick among these several options that we have? We have two considerations. One is primary consideration, second one is secondary consideration. Primary consideration is very simple. We need to keep our financial statements true and fair. In order to keep the financial statements true and fair, whichever accounting policy gives us the best results, we follow that accounting policy. If both the options that we give, both the options that we have are giving true and fair view, then we go to secondary consideration. Secondary consideration are three. 1. Prudence. 2. Substance over form. 3. Materiality. It is not one of these, but all the three of these have to be considered. Prudence, by prudence we mean practicality. You need to be very practical when you do accounting. An example for prudence is conservatism. We need to account for expenses as and when we incur, and we need to account for losses even before it materializes. However, if you expect an income, it is not conservative to record it till the time it materializes. So by prudence we record profits and assets only when we acquire them, but we record the losses even before we actually incur that loss. So we are trying to record our profits and assets at not an overstated value, but if in case we expect a loss or we have a liability, we don't want to understate it. That's the concept of prudence. And when it comes to substance over form, we need to ensure that we record the items by their reality and not just by legality. If in case you buy an asset but it's not registered in your name legally, just because it is not registered in your name legally is not a sufficient area for you to postpone the recognition of the asset. Asset has to be recognized based on substance over form. Wherever there is a clash between accounting reality and legality, accounting reality will win over the legality, and you need to go by the reality in accounts to record the same. We'll have an instance of this in accounting 4 also, accounting standard 4 also, and you'll read this in multiple other places. And the last one is materiality. Materiality is we need to disclose all the items which are going to have substantial or material impact on the user. Now, by disclosing this information, the investor will take a different decision, and by not disclosing this information, an investor will take a different decision. In such a scenario, it is our responsibility when we prepare financial statements to disclose all such information which is material and necessary for the user to take his decision. So I'll quickly run you through everything what I just told now. The basis to decide accounting policy are true. The primary consideration is to ensure that the financial statements have true and fair view. The secondary consideration is prudence, substance over form, and materiality. Next, there are certain assumptions given under accounting standard 1 which are called as fundamental accounting assumptions. These are going concern, accrual, and consistency. The reason why these are called as fundamental accounting assumptions is whenever we follow going concern, whenever we follow accrual system of accounting, or whenever our accounting policies and principles are consistent, there is no need for any separate disclosure. However, when we don't follow going concern, when we are not following accrual system of accounting, or our accounting policies followed are not consistent, then it is our responsibility to disclose that we are not following going concern, we are not following accrual system of accounting, or this specific accounting policy is not consistent. So with regard to fundamental accounting assumption, no disclosure is required when it is followed. However, disclosure is required when it is not followed. All of these significant accounting policies, what we call as SAP, is followed in preparation and presentation of financial statements. All of this should be disclosed. Now, can I disclose this in various places? I'll disclose one accounting policy in balance sheet, one in P&L, one in cash flow statement. No, you need to disclose all of them at one place. All the accounting policies which are significant, which are followed by the organization, are required to be disclosed at one place. And if in case you have not followed any specific rule of accounting, any specific policy which accounting standard mandates us to follow, we have followed the policy which accounting standard doesn't want us to follow. Like simple average method is not allowed under accounting standard to valuation of inventory. If you followed it, you will disclose it, but disclosure is not a remedy. I cannot go kill someone and then say, yes, I agree, I have killed. You can't sue me now, or you can't put me behind bars now, because I am accepting it myself. Acceptance is required, but acceptance is not a remedy. Acceptance doesn't make the error good. Error will remain an error. Not following the accounting policy to be followed, or following the wrong accounting policy, requires disclosure, but such a disclosure is not a remedy for doing something wrong. And the last point that I want you all to note with regard to accounting standard 1 is changes in accounting policy. I told you some time ago that going concern, accrual and consistency is a fundamental accounting assumption. An organization should be consistent when it comes to the way it prepares, the way it follows accounting policies from one accounting year to another accounting year. But are you allowed to breach that flow? Can you stop that flow? Can you follow a different accounting policy from one year to another year? The answer is yes. You are allowed to change your accounting policy, which is an exception to consistency. But in order to change your accounting policy, it should be one among the following three reasons. Reason number one is the statute or the law has changed and the law wants you to change the accounting policy. Or the accounting standard has gone through a change and the new accounting standard wants you to change the accounting policy, or the paragraph in the accounting standard has been amended requiring you to change the accounting policy. Last one is for the sake of appropriate presentation of financial statements. Maybe you followed an accounting policy which is correct, but there is another accounting policy what is best suited for your organization. It will show better financial results, better presentation of financial statements. When I say better presentation, I am not meaning to say higher profit. More appropriate, more reliable financial statements, or more reliable financial statements can be prepared with such change in accounting policy. In such cases, you should change your accounting policy and adopt the new one. And this is the quick revision on accounting standard 1.